Hey guys, thanks for joining me today. Hopefully, this is the first of a recurring series on becoming an excellent portfolio manager. This first iteration is going to be about managing your risk and mastering volatility. And the reality here, guys, this is Bloody Wednesday with Bitcoin down. Who the hell knows how much? It keeps going down, seems like every few minutes. And that makes it even more critical to manage your risk and to understand the volatility of your portfolio. The reality is, even if all you're doing right now, at least what you think you're doing, is going in and out of Bitcoin, that's not really what you can be. You can be so much better than that. You can be so much bigger than that. You could be a true blue portfolio manager. And the reality is, one day you will be, no matter what. Maybe you're a student right now and you're just doing Bitcoin here and there. Maybe you're a bit older and you got some stocks, got some real estate, got some bonds, a 401k, whatever it is. Maybe one day you'll be there, but the reality is one day you will be a portfolio manager, at least of your own assets. Ignorance is not an excuse. You got to manage your volatility and you got to manage your risk. So that's what we're going to do today is we're going to recognize that. We're going to teach you guys how to become portfolio managers, teach you guys how to manage your risk. This is going to be pretty darn in-depth. I can make some funny videos, but this will not be very funny, even though I'm kind of a dork here and there, but that's all right. I got you guys a nice spreadsheet you can find either on my YouTube feed or my Twitter feed. And I'll leave that up. And I got a bunch of calculations in there, and you can dive in there, change numbers, do whatever, just give you an idea, how things really break down. So first, I'm going to give you a basic definition of volatility. I just ripped this straight from Investopedia. It's a pretty, I'd say, weak definition, but it will do its job here. So I bolded some things we can just highlight here. Volatility can be measured by using standard deviation. That's primarily what I will be doing today. So when people talk about risk, especially on crypto Twitter, they're just talking about stop losses and crap like that. That is so bare bones that it's kind of makes me chuckle. You got to go so much deeper than that. And that's what we're going to begin to do today. One thing you need to know, if you have higher volatility or higher risk or higher standard deviation, naturally, you have a riskier security, a riskier portfolio. What does that really mean, though? That means if you have a higher volatility, that your security or coin or portfolio value can be potentially spread out over a larger range of values. Well, guys, guess what? Again, Bloody Wednesday, you just saw Bitcoin go down, I don't know, a dozen, maybe even more, 15%. I'm not looking right now. So Bitcoin and crypto, it has a very high standard deviation, a high volatility. So the expectation needs to be that things can be very dispersed. You can lose a lot very quickly. And then also, I am kind of in my professional life, I manage equities, manage portfolios, and we report volatility, standard deviation on basically everything. It's very common. So it's very wise for you to recognize and understand what these things mean. So I'm going to jump right in, and we're going to be doing some math. So you can leave the feed now if you don't want to look at some math, but you guys will learn quite a bit, I promise you. So let's jump right in. Let me know if you have any questions. I got the chat open. I'll say something now. And obviously, feel free, and I would love it if you guys would retweet or spread the video around and kind of go from there. The more viewers, the better. So first, I'm going to teach you how to actually calculate variance and standard deviation by hand. So blast to the college or high school past right here. So on the left-hand side, I have Bitcoin's daily returns from 1/1/2016. I'll scroll down. It keeps going down all the way down to, this is Bloody Wednesday. It got a little bit worse after close too. So As you know, I run a quantitative model that ranks coins every single day, so I get these returns all the time. So I just kind of rip that from there. So I have all those returns. So that's calculate standard deviation. So what is standard deviation? It's a measure of dispersion around the average return. So let's do a basic calculation. Yeah, I'll go back to the definition here. And once you see the formula, you'll better understand exactly what it is. But what you're doing is, let me look through here, what might be the best way. Yeah, this right here. Volatility refers to the amount of uncertainty or risk related to the size of changes in a security's value. So the greater the standard deviation, the less certain you are of the return you're going to get, the wider dispersion of potential outcomes. So a lower volatility, like something like cash, has very, very low volatility. You're very certain of the return you're going to get. Something like Bitcoin, something like crypto, you're very uncertain of the return you're going to get in short periods. In very long periods, if we're talking 3, 5, 10 years, maybe your certainty goes up a little bit. But day to day, week to week, month to month, you have high uncertainty when it comes to crypto. So in terms of definition, I might crystallize when I show you how to calculate it by hand. So the first step in doing this by hand, and I never do this by hand. So variance is around the average, basically. Yeah, so it's basically, to get kind of geeky, it's the square root of the square deviations from the mean. So what does that mean? So I'll show you. So the first step here is get the average return. So I got these formulas here so you can see exactly how I did it. Average of B2 to B1000. Then it's kind of locked it down all the way down. So the average daily return of Bitcoin since 1/1/2016 is 37 basis points, or 0.37%, which is really high. In the future, I would expect it to be quite a bit lower, but that's what it's been. So the deviation around, will this be recorded? Absolutely. So you can always jump right back in, and spreadsheet will be available too. So the deviations, so variance is around the average. So part of that is the deviation from the mean. That's basically just subtraction. So the return subtracted out by the average return. And then you have to square it, mainly because you got to get rid of the negatives. So that's what I'm doing here, simply squaring it. And then if you do the average of the squared deviations, so this is the squared deviations, this is the average of the squared deviations. See, F2 to F2000 is this number, and this number is the variance. If you take the square root of that, you have the standard deviation. And then over here in K, I did the handy dandy formula. This is in Google Docs. Excel's a little bit different. If you guys code in MATLAB or R, the code might be a little different, but you'll get the exact same answer. So you can see I did it by hand in I2 and did the quick code here in K2, and they match. So hopefully that kind of gives you an idea what standard deviation is. So if you have wider returns around the mean, so bigger dispersion of returns around the mean, you're going to have a higher standard deviation. And as we walk through this, you're going to see why that's important. And again, if you have questions, feel free to jump in. So here, I'm going to kind of give you a high level of some ways us equity portfolio managers look at both risk and return. We generally look at things like this over what we call rolling periods. And here I'm going to show you why looking at risk in terms of volatility, in many ways is preferable to looking at return. So again, in columns B and C, I got Bitcoin's return. I hit a bunch of cells. So I got these numbers 1, 2, 3, 4, 5, then 355. So a bunch are hidden. But down here, I have the 1-year annualized return. So this is simply the previous 365 days, average of it multiplied by 365. So it's not the cumulative return. It's not the total return. It's the average, daily return annualized, which is pretty good, 92% on this date, and the rolling 1 year annualized volatility. So the same formula we used on the previous page, but in this case, to annualize volatility, you can't just multiply by 365. You have to multiply by the square root of 365. For crypto, if you're doing stocks, you would do number of business days. So it's like 252. It just depends. And generally, this trick to annualize daily data is okay to use, but in crypto, volatility is so high, it actually screws up some of the data. So I'll actually show you why. But I got this going down. So these are rolling returns and rolling volatility all the way down here. Now, one thing that's interesting, see these volatilities are getting high. Now, it actually breaks 100. And this is where I was saying this trick of annualizing volatility doesn't necessarily work for crypto, is because you can't really have a volatility greater than 100. Part of the assumption here is returns are normally distributed. Now we're really getting in depth, but the point is you can't really have volatility because you can't go below 100%. Sure, can I repeat what rolling means? Yep, absolutely. So I'm going to assume a lot of you guys looked at charts. You do a lot of TA. So one thing you might do is look at the monthly candle. So what's the monthly return? And let's just pick a month that has 30 days. So at the end of the month, the return of the candle is the 30-day return. But on the first of the month, the very next day, there's not a monthly candle anymore. You're on the new candle, a fresh candle. However, there's still a 30-day return. It just moved 1 day forward. On the second day of the month, it moves another 1 day forward. So you can see it here. I have C2 to C366, just 365 days. If I go 1 day ahead, it's now C3 through C367. So 1 day. So it's always 365 days in this case. It just moves 1 day at a time. Now you can do rolling periods of 1 year. You can do it of 1 week. You can do it of anything. But what it does is it helps you pick up the trend changes a bit faster. But what I really wanted to highlight here is this little chart, and I usually don't make charts in Google Docs, so I didn't bother to try to make it pretty. But the red line here is the volatility, the rolling volatility, so column G, and the blue line is the rolling return. So what's important to note here is the red line is much, much more stable than the blue line. So what that means, as a portfolio manager, as I manage equities in kind of my real life, I have a much higher conviction. I can predict the future volatility, the risk of my portfolio, much more accurately than I can predict the return. And that's important to know because returns have tremendous amount of error in them. That's just the way life is. But risk, of course, everything has error, but not nearly as much. So having a better grasp of your risk, it's easier to manage and easier to know kind of what you're getting into and what to expect. All right, so now kind of jumping into the nitty gritty, and this is where I think it's important for you guys to recognize your portfolio managers. You're not just, one asset, long, short, Bitcoin traders. Because I'd imagine most of you, in some way, shape, or form, you probably long-term hold a couple of coins, maybe Bitcoin, maybe some others, maybe you have some stocks, whatever it might be. So I want to display what a portfolio volatility, a portfolio risk, and diversification actually gets you, utilizing real data here. And I know many people say there's no diversification in crypto. Well, that's false, completely, 100%. I mean, one, you can look at my quantitative model, and if you invest in the top 10 or top 25%, you make quite a bit of money. Invest in the bottom 10%, you go bust, even a bull market. So clearly, coin selection matters. But in terms of risk and correlation, it also matters. So here we have Bitcoin's return, Ethereum, and Ripple, or XRP, whatever you want to call it these days. Again, same dates, 1/1/2016 through today. And this right here is the individual daily volatilities. So I didn't annualize these guys or anything. They're just straight up volatility. So Bitcoin has a volatility of 4.13, Ethereum 6.79, and Ripple 9.78 over this, call it 2.5 year period. And here are the asset returns. So daily average returns. Ethereum did the best, Ripple a little bit worse, and Bitcoin 37 basis points, all excellent returns. So what if we actually built a portfolio of Bitcoin at, say, call it 70%? I'll make these into percents. Ethereum at 15% and Ripple at 15%. So what actually happens here? Well, this is the portfolio here. And for those that don't know Excel or Google Docs, I'll show you the formula. So I'm just doing a sum product of the returns of the three securities or coins and the weights. And then, I lock it down as absolute reference, the B3 and D3. I can just track it down. So these are your returns. What would your average return be of your portfolio? Be 49 basis points. That's actually just a linear combination, which I'll show you in a bit. But what is your volatility? It's not your average volatility. It's your actual volatility. It's 4.03%. Well, if you notice anything, the volatility of your portfolio of just these three assets, very popular coins, it's lower than if you held Bitcoin by itself. So you're reducing your risk by buying 15% Ethereum and 15% Ripple. And you're boosting your return compared to Bitcoin. Why? Diversification. Now, we can change the weights here and see kind of what happens. If you boost the weights to Ripple and Ethereum, your volatility goes up naturally. If you make it really low, something like this, it's going to keep creeping up, but your return creeps up. We can do something like that. So 80%, 10%, 10%. And you can see clearly your volatility is lower in this portfolio compared to Bitcoin because of diversification. And hopefully that makes sense to you guys. And I will actually kind of walk through that a bit more in depth in a second. So that's what I basically said here. So how can you have higher returns yet lower volatility? And it's due to correlation. So when I said returns are a linear combination, I'll show you what that means. So remember I talked about a sum product before. So here is a sum product of the individual asset daily returns. So the Bitcoin of 0.37%, Ethereum 0.79, etc. And the portfolio weights 0.8, 0.1, 0.1. The return is 0.45 based upon this just simple linear combination. If I actually did the whole, that's what this guy is. But this right here is if I did the average of all the returns, it's 0.45%. So if they're the exact same return, so it's linear. So Tom, mentioned a great question. How can you plot all the combinations to determine a portfolio that has the ideal return volatility trade-off? That is perfect. So you're basically talking the Sharpe ratio, and Harry Markowitz and Bill Sharpe all won Nobel Prizes basically for that. So that's a optimization problem. And you can do it in Excel, you can do it in a lot of places. But what you're doing, what you're talking about right there is maximizing your risk-adjusted return. So return divided by volatility, given portfolio weights, which Excel can do it, Google Docs can do it. I think it can. Every MATLAB R can do it. A bunch of software does it. I mean, that's actually, frankly, how I build portfolios in my day job too. So I have risk predictions, I have correlation predictions. In many cases, return predictions, and then you can put it in an optimizer to maximize that risk and return trade-off. But you also have constraints. So for example, some optimizations, maybe you don't want to be able to go short, or some of them you want to constrain how much you can have in any one holding. So I have 80% in Bitcoin. Perhaps I wanted to maximize that at 50%. You can put a lot of constraints on these things. But if we want to talk about diversification benefits, so I showed you guys the linear combination of returns of the sum product B7, D7 versus B3 to D3. If we did the same thing for risk, B10 through D10 multiplied by B3 and D3, you'd get a volatility of 4.96. But the actual volatility of the portfolio is 3.96. So by diversifying, by buying a couple different securities and having diversification benefit, you're actually reducing your volatility. The benefit of diversification is almost 1%, which is pretty high. I mean, you can call it 20% of your volatility is being reduced due to diversification. So I mean, this is rock solid empirical data from Ethereum, Ripple, and Bitcoin, 3 major currencies, that say, hey, if you actually invested in these 3, you would reduce your volatility. Again, any questions, feel free to ask. So here I'm diving into why that diversification benefit actually is. So I mentioned correlations, and I apologize. Again, not really funny today. It's pretty late, and but I think it's pretty important given how bad Bitcoin gotten beaten down today to kind of go over the dry stuff, because we all need to be better portfolio managers and work together. And you guys teach me, I teach you, and hopefully we all, get a Lambo, whatever the heck you want to get, whatever your dream is. So anyways, so I got the Bitcoin, Ethereum, Ripple returns here. Again, exact same thing I had before. But what about correlation? So what's driving that? And I'll get to the actual formula of what's driving that diversification benefit. Well, it's correlation, and the whole period correlation is right here. So Bitcoin, Ethereum is just, here's the formula. Correl, B2 to B980, you can see it here. So the correlation of Bitcoin and Ethereum is 37% or 0.37. Bitcoin to Ripple, 0.22. Ethereum to Ripple, 0.2. So all fairly low, to be quite honest with you. But that's, we always kind of have to dive a little bit deeper. So what I did here, and we talked about rolling periods earlier, here I'm doing a 30-day rolling correlation. So correlation, B2 to B31, and then I'm just dragging it down. So these are the correlation of Bitcoin, Ethereum for the last 30 days on every 30-day period, went all the way down. And that's what I have over here. So I graphed it for you guys. So this is actually really, really interesting. Yep, Tom, exactly. It works because assets aren't perfectly correlated. That's exactly right. So if assets were perfectly correlated, I have a toggle on another page where you can see if assets have a correlation of 1, there is no diversification benefit. So this chart is showing the 30-day correlations of Bitcoin, Ethereum, and Ripple. You can see clearly if we just graph the trend line, it's been increasing over time. And recently, I don't have the dates on here, but the right side is recent. You can see it's very high when you're looking at the past, call it 6, 7, 8 months. So correlations have been going up. So diversification benefits have been coming down. However, this is a well-known phenomenon when you're in bear markets or stress markets. Correlations spike, whether you're talking equities or anything, any risk asset really, correlations go up. So I wouldn't expect correlation to be this high, once things return to normal. Thank you for the comments. So I would expect correlation to come down a bit, especially when you're talking some obscure altcoin on some obscure exchange. I mean, these are the big mega caps here. And yeah, they have high correlation now, but that's because we're in a stress market. I would certainly expect them to come down over time. All right, so now I think we're getting into this, what I would consider even more important than what we've done so far, if not the most important thing uh, in this deck here. However, this might be the most complicated, and we're actually kind of getting into more complex stuff. So what we're doing here is we want to recognize the likelihood of losing a lot of money or making a lot of money. And we can do that via the standard deviation that we calculated before. And maybe you've heard of a term called like value at risk. And I'm not precisely calculating that here, but kind of pretty darn close. And that's one thing like banks use for stress tests and various things like that. So what we're trying to do is calculate how often. So I can actually tell you precisely how often you should expect to have a day like today. How many days a year or a month are we supposed to have a day like today? You should know that, right? Like you should know how often your portfolio should lose 5% in a day, 10% in a day, 20% in a day. How many of you actually know that? And I think that's very critical to know. So I will actually show you kind of how to calculate this. So again, here, A and B, same returns we've had before. Yeah, red, var, yes. So I got the returns in A and B. So I'm just going to quickly read what I have in this box right here. So prices are randomly distributed, and they're not really, especially crypto returns, but it's an okay assumption. And then about 68% of data values will fall within one standard deviation, 95% within two standard deviations, and over 99% three standard deviations. Now, many of you probably have heard of bell curves or normal distributions. That's exactly what this is here. So what I'm going to calculate here in C is how many standard deviations the return next to it was away from the average. So I'll just walk you through the formula here. So B2 is the actual return of that day, 87 basis points, so 0.87%. Minus the average return, 37 basis points, or 0.37%, divided by the standard deviation. So that return was only 0.12 standard deviations away from the average return. You go down to this date right here, 1/15/2016. That day was negative 3.81 standard deviations away from the average day. It's a really negative day. And then kind of pull up spreadsheet and scroll down and see every day here. So you have like 5/28/2016, a very positive day, 2.81. Remember here I'm using daily data, Bitcoin being 24/7. You can slice and dice it a variety of ways. So some of these days actually probably had bigger drawdowns intraday, but that's neither here nor there. But we want to see what's over here. This is what's really critical. I'm reading some of the questions here. So any hypothesis on what drives increasing correlation in stress markets? I think you can see it today, right? So everybody started, not me, but everybody probably except me started dumping their holdings en masse together. So it's a lot of it's herding behavior. You don't want to miss the boat. Overreaction to what's going on. It's a lot of behavioral biases that come into play in stress markets, and that lead to people behaving very similar, than all assets being driven down. So here, what I did is I just hard-coded returns. So I just dropped down by 1%. So a loss of 20%, loss 19, 18, 17, all the way down to positive 20. Then here, I calculated what the Z-score, remember, is just how many standard deviations away from average that return is. So a loss of 20 is negative 4.94 standard deviations away from average. And here, remember, average 37 basis points. Usually probably wouldn't want to assume a gain of 37 basis points, but with Bitcoin and crypto and volatility so wide, the 37 basis points is kind of immaterial. So what we have here is P, Q, R, and S, and this is very powerful data that you should know. I got another question. If we look at distribution of Bitcoin returns, how closely do they approximate normal distribution? Not as close as what something like stocks do. So is there a better distribution? I haven't researched that. I mean, I would say Bitcoin probably has a skew and fat tails, just my assumption, but I haven't necessarily researched that yet. But with the same as like stocks and even things like emerging market stocks and Chinese stocks, the assumption most people use is still normal distributions. So a loss of 20%. So how often should a day be better than a loss of 20%? Well, 99.99996% of the time. So of the year, how many days of the year should be better than a loss of 20%? 364.9999, so on and so forth. So how often should we be worse than a loss of 20%? 0.00004%. So, I mean, those are really small numbers. So let's pick something a bit more reasonable. So let's just say 10%. That's probably close to what Bitcoin did today, maybe a little worse. So how often should we be better than a loss of 10% in a day? 99.4% of the time. What about worse? 0.59% of the time. How many days of the year should we be worse than 10%? Only 2.2 days. So if today was a loss of 10%, which I don't think the official daily candle was 10%, I think it was 7 or 8, but we should only have a daily candle worse than 10% twice a year. If Bitcoin is normally distributed, it's not, it's skewed, so it's going to be a little bit higher. But what about 7 or 8? So a loss of 7, we should have a loss of 7% more than once a month. So this is what's crazy, and people just freak out all the time. I would actually argue a loss of 7% is a once a month occurrence. Is not something where you should, throw your hands up and get all crazy and pissy about and sell everything. That's going to happen all the time. Once a month, you should expect to lose 7%. What about something like 5%? I mean, 5% is still a healthy chunk of money. And you rarely, if ever, see that in stocks. You should see a loss of 5% or more 3 times a month. If you think about that, I mean, that's little under once a week that you're going to have a loss of greater than 5%. Now, I think all of us, we wouldn't be here if we weren't extremely bullish in crypto and Bitcoin in the long run. But if you bigged out and freaked out and sold everything every time you had a loss of 5%, you're going to be selling everything basically once a week. Maybe a little bit. Technically, a loss of 4% is almost precisely once a week. So you need to be really careful to understand just the probabilities and random chance of volatility. That's kind of what it's telling you. There's an element of random chance. And we're going to lose 4% or more about once a week. So just keep that in mind. So it's not a matter of necessarily getting worried or freaked out. I mean, that's just what's going to happen. What do you mean by fat tails and skew? Probably easier to, if I had a normal distribution to show you, it basically means the ends of the distribution have, if it's normal, it has a certain thickness. If you have a fat tail or a skinny tail, it's going to be the thickness of the ends of the distribution are either going to be wider or skinnier. And skew would mean it's kind of pushed to one side or the other. And if you can explain a bit deeper, what do you mean by time-based volatility? I'll be happy to answer. But we can also I still have the data here if you want to flip on positive. So for example, how often should we beat? How often should we have more than a 5% return? Again, that's actually a little bit less than once a week. But what about a 4% return? We should have more than one 4% return day per week. So that's just something really important to keep in mind, that, hey, these things happen and there's an element of chance. So especially when you have these small returns, whether it's 2, 3, 4, I mean, you're right in the belly of the curve. I would argue a lot of that is just noise, random chance. So I wouldn't necessarily ever get freaked out about a 2, 3, 4, even 5% return. Now, if you're hitting like 12, 13, like today, and that obviously ring some alarm bells, because that should rarely occur. But yeah, so just keep that in mind, how often these big negative return events should actually occur. And this is in Bitcoin. If you recall, like Ripple had a much higher volatility. So these numbers would actually expand out for more riskier assets. All right, so this is my last slide here. Okay. So 3% moves at certain time of the day. Yeah, it's trickier to get like minute by minute data. So I haven't necessarily done that. Now in short periods of time, I've seen and studied, like we might go through a couple week period where it just seems like 4 o'clock, say my time, you'd always see a pump or a dump. And that would happen for 5, 6 straight days. Then it would go away. But it doesn't seem like, at least to me, that there's any long-term consistency, with that. Although some people say different, when America is awake, things are more volatile. I don't know if that's necessarily the truth, but it depends. So like if the volatility is driven by like regulatory news or some, SEC saying something, of course it's going to be more volatile during, America being awake. But if China bans Bitcoin or whatever happens, across the globe, then you're going to have volatility overnight, at least for me, because I'm in the States. All right, so this is the most in-depth page here. And I think this is critically important. And this is actually why most people, at least why they should say you shouldn't have more than 5, 10, 15% of your invested capital in crypto. I think many people just say it because they don't know any better, but there's actually a very specific reason. Now, if you're a massive risk taker and you're real young, maybe that's a little different. Of course, that all depends on your risk tolerance, your situation, which of course I don't know. And I'll show kind of empirically why that actually makes sense to have Bitcoin as a smaller percent than probably what you'd expect. So here I have monthly returns, October through August, Bitcoin. Then I have the S&P 500. It's actually SPY ETF via Spider, State Street, same dates. And I didn't build this very easy to see, but I just put a portfolio weight of 20% and 80%. So 20% Bitcoin, 80% into equity or State Street ETF, Spider, SPY. So if you did that, you get this portfolio. And I showed you the sum product before. It's just a linear combination of the two asset returns and your weight kind of going down. But we're less concerned about actual return. So Tom asked, so knowing Z-scores, it seemed useful in having awareness of the probability of a major down day or up day. Beyond that, do they insist in portfolio construction? I think, absolutely. So like I would say more portfolio managers, instead of using, stop losses based upon just a number that they chose, they would take money off the table from their portfolio, maybe de-risk their portfolio if their value at risk, which is driven by the Z-scores and standard deviation of the portfolio, got too high. So it's just a measure of how much capital you have at risk at any given moment of time. So that's one pretty common way people use it. So here I have the monthly returns again, and I calculated the annualized volatility. So just basically the standard deviation, which I showed you guys before, times the square root of 12. So you have 12 months in a year. The S&P 500, same exact thing. You see the volatility is dramatically different, 94% for Bitcoin and 7% for equities. Equity volatility has been extremely low over the past year or two. If you guys have been paying attention to that, that's been huge headlines. So that should spike, at some point. The correlation between Bitcoin and S&P 500 monthly data points over these past 2 years is really low, 7.5%. So what is the portfolio standard deviation? So I'm using just the returns here. So I guess I'm showing you again how to do it by hand. So the returns here, just the standard deviation times square root of 12, and that's 20.19. And this is actually a pretty complex formula I'm about to show you guys. If I can get over here. So if any of you end up doing the CFA program or you become professional portfolio managers, you're going to definitely see this formula and probably have to calculate it. So what we're doing here, this top one in particular, is calculating the standard deviation of a portfolio with 2 assets in it. In this case, the S&P 500 and Bitcoin. So it's the weight of asset 1 squared times the standard deviation of asset 1 squared plus the weight of asset 2 squared, so on and so forth. The P is correlation of asset 1 and 2. And then you take the root of it. So I'm doing it by hand here for you. And I'll show you how it actually maps out correctly. So this is just the first term, the weight of asset 1 squared times the variance of asset 2, and then the asset 1, sorry. And this is the weight of asset 2 squared, sorry, I'm getting tongue-tied here, times the variance of asset 2. And this is that second term, 2 times the weight times correlation times standard deviation, so on. Sum up the terms, you take the square root, and that is precisely the number we got before. So again, kind of proving that this formula is actually the real deal. And here, I showed what standard deviation would be with no diversification benefit and how much diversification benefit you actually get. So this is, you actually get a diversification benefit by combining Bitcoin and equity together. And who'd have thunk it? Now, I think somebody asked in the chat, what happens if you have a perfect correlation? Let's make it 100. Make that 100% correlation, you get no diversification benefit. So 24.8 and 24.8. If you have perfectly uncorrelated assets, you get massive, the most diversification benefit. And what we actually had was 7 and change, which I'll have to calculate again. Sorry about that. I'm not that's annoying. I'm not a Google Doc fan, to be honest with you. I find it clunky and slow. All right, so we're good to go there. So you can see that again, the diversification, benefit of having equities and Bitcoin together. But really, I wanted to highlight what I call risk contribution or risk weight. So most people here, if I ask you, what's your weight in Bitcoin? You would say 20% right here. And 80% in equities. And you would be right. I mean, that's your nominal capital weight. That's how much you have tied up in terms of your capital. But what about your risk? What's actually driving that 20.19% risk? How much is Bitcoin driving that 20.19? How much is the S&P 500 driving that 20.19? And that's what we have down here. So this is a pretty advanced topic. So risk contribution is, so the contribution to your portfolio risk is the correlation of Bitcoin to the portfolio times the weight of Bitcoin times the individual standard deviation of Bitcoin. So here I have the correlation to the portfolio. So this is just using the return streams to the top left here. So B3 to B25 and D3 to D25. So Bitcoin is highly correlated to the portfolio, which there's a good reason. Bitcoin is highly volatile, and we'll see why the correlation is so high. The S&P, the correlation is much lower, 36%. Even though the equity portfolio, the equity asset, the S&P, is 80% of your portfolio. Keep that in mind. That's a very important nugget you have to remember here. So what about portfolio risk contribution? This is the formula I just mentioned. It's weight times standard deviation times correlation. And that's these two numbers here. So if I add them up, what do I get? I get 20.19. I get precisely the portfolio standard deviation. And if I do the weight, so 18 divided by 20.19 and 2.17 divided by 20.19, I get your risk weight of 89% of your portfolio risk is driven by Bitcoin, and only 10% is driven by the S&P 500, even though your actual weights were the complete opposite. This is why, just having 2, 3, 4, 5% of Bitcoin in a portfolio can still dominate your returns. Now, again, if you're young and you want to take a lot of risk, again, that's kind of up to you, but keep that in mind that Bitcoin is driving basically all of the risk in your portfolio. Remember, Bitcoin's the least volatile cryptocurrency out there besides the stable coins. So if you put Ripple or Ethereum or Bcash or anything out there, it would be even higher than this. But it's very critical to know that, hey, just a slight sprinkle of Bitcoin could easily dominate and take over your portfolio, even if it zigs and zags in different ways to the S&P 500. That actually kind of wraps up what I had here today. Hopefully that was kind of a decent starter. Hopefully you guys understand volatility a bit more and the importance of volatility. I think the key concept really is the higher the volatility of the asset, the greater the dispersion of returns. And the more you should expect that dispersion to happen. Like I mentioned before, I think it was 5% should happen, maybe once a week, maybe a little less than once a week. And when you see people kind of jumping out of windows when you lose 5%, I mean, that's a common occurrence. I mean, that's, for those that do it, it's like going to church, once a week. So just have to keep that in mind. But if you guys have any questions, feel free to message me on Twitter, even in the chat. Again, love it if you retweet stuff and support the stuff I'm trying to do. Like I want to, I love this community, and I think it's amazing, how such a diverse set of people all want to teach and learn from each other and grow something special. So I just want to do my part the best I can. Okay, Tom asked a question, understanding the S&P 500 and Bitcoin correlation. We're heavily constrained by our sample. Yeah, we've had a bull market in equities over this time, so we don't know how Bitcoin would react if equities go bear. Thoughts? Yeah, so what's really interesting here is the correlation. You mentioned, bull for equities. The correlation between Bitcoin and S&P 500, even in this period, which you almost consider a bull market for both, by and large, even though Bitcoin's down the past 6 months, it's still up enormously over the past 2 years, is basically no correlation. And I would actually suspect, even from a theoretical standpoint, Bitcoin and equity should have minimal, if not close to zero, correlation over time. I mean, the reason is, I mean, some people don't even know if it's a risk-on asset, as in, people want to, pile into risk, which would make Bitcoin go up, which is actually what equities are too. It's a risk-on asset. In that case, correlations go higher, but Bitcoin could also be a risk-off asset, as in, crap's hitting the fan, emerging market currencies are going down, equities going down, maybe there's a recession, so everyone piles into Bitcoin. I mean, nobody necessarily knows yet, and I think it's kind of all of the above. I think for now, Bitcoin is so early on that it's going to just chart its own course. Maybe in the future, once I think Bitcoin, at least my hypothesis is in 5, 6, 7, 8, 9, 10 years, Bitcoin will be what I consider a minor global currency. So it's not going to replace the dollar, the yen, or the pound, or anything like that, but it's going to kind of stand just underneath them. So on the same playing field. So it's going to be treated more like a currency then. And I think then the correlations in the behavior of Bitcoin will change. And then, different coins will be different purposes, obviously, whether it's platform or utility coins or, BNB fee-based coins, whatever it might be. You're welcome. Thanks, Red. What data would I look at on determining whether it's a risk-on versus risk-off asset? Generally speaking, so the US dollar is a risk-off asset. So it's basically whatever you think risk-off asset, you want to think flight to quality. So when you think flight to quality, where would you generally put your money? And you see that the US dollar, US treasuries mainly. So if bad things are happening around the globe, for whatever reason, you generally see money flow into the US. You see US treasury rates go down. You see the US dollar strengthen in that case. Then you have things like gold and some precious metals. I would say by and large, that's kind of going away. We see quite a bit of fascination with crypto Twitter with precious metals. I don't necessarily know why. I think that's even their roles as inflation hedges are kind of going away. So that's neither here nor there. I'd say some other global major currencies kind of are risk-off assets, whether we're talking like the euro or the pound, even the yen to a lesser extent. And then risk-on assets, you can just kind of look at high volatility, so emerging market stocks, even just stocks in general. Of course, obviously, like things like Bitcoin is a high-risk asset, but it just behaves a little different. Thanks for the questions, Tom. Okay, yeah, I think my wife probably wants me to wrap this up, but I just enjoy hanging out with you guys, doing what I can, and hopefully we get some better returns and a good bounce back tomorrow. But if you have any questions about either any of this or my quantitative model of ranks, feel free to DM me or whatever, shoot me an email. I'll be happy to answer. So you guys have a great night, and thanks for joining me, and I'll see you soon.